Well, I thought the rally was a little too much. I mean, we talked about it a couple weeks ago. Conditions really aren't any better, and the earnings estimates are way too high. So to me, what the rally was about was positioning and sentiment. And I started hearing a couple weeks ago people say, oh, maybe things are better. Earnings weren't as bad. The CPI rolled over. There was a narrative that there was some fundamental improvement, but I don't believe it. I don't believe it.
Well, those aren't true. I mean, the earnings weren't as bad as feared. Inflation seems to have peaked. But the narrative that you can call into question, perhaps, was the one around Powell, that Powell pivoted or signaled that it was like peak Fed, peak Powell, and that the markets were up like 8% since the day of the press conference.
Yeah, we'll see what they say at Jackson Hole this week. I don't expect it'll be dovish, but I don't even really care. Okay, what I care about is the fact that every consumer industry in the stock market for the last 20, 30 years grows its revenue 6 to 8% per year, and they all just grew 20% plus. So I know they're over-earning. Why has it taken longer than people thought? Why were earnings maybe not as bad? Because the Fed started lifting in March. Fed fund futures went up last year, but they didn't lift in March. So the idea that all of the impact hit earnings from April 1st to June 30th, when we heard about it in July, I think it's a little unfair.
Well,
I think it unfolds over the next 2-3 quarters.
Well, what's it mean then for where stocks go from here? Are we going back to the June lows?
I think we're going lower in the short to medium term. I don't think there's any statistically significant data that September is a bad month. I think that stuff's a little bit astrology. You need another 1,000 years of data to prove it. But I do think the risk reward skewed to the negative. I think when analysts come back after Labor Day vacation and sharpen their pencils on what's going on for the rest of the year in 2023, the numbers are coming lower. Now, 2023 numbers right now are $243 for the S&P. We're at 41.38 last. I think the real number is 215. About 12, 13% lower. So will stocks act great when the numbers come down? Probably not. I think there's real risk that the numbers come materially lower by sort of January.
A real risk that they come way down. Do you think it's possible, though, that we could be at peak hawkishness and that we're not going to necessarily see 75 basis point cuts going forward, and that maybe that in and of itself justifies part of the move that we had?
Anything's possible because these guys were buying billions and billions of dollars of mortgage-backed securities when the housing market was on fire in every MSA in America. So I wouldn't have done that, and I'm surprised they did. So that's why I say anything's possible. What do I know, Scott? I know the CPI is going to stay high. So if people got excited that there was a rollover because energy and food came down a little bit, they have to kind of take a step back and say, what matters to CPI? It's owner's equivalent rent. Talk to any of the guys you have on the show who own tons of buildings and apartments, and they'll tell you the same thing. Rents are going up 1% a month everywhere, and it hasn't paused for a millisecond.
Hey, Liz Ann Saunders made an interesting point with Santoli in the last hour. She said, what happens if the Fed comes out, let's say Powell on Friday at Jackson Hole, gives you the idea that maybe they don't have to get inflation down to 2%, right? Maybe the target that everybody says, they can be a little flexible on the target. Maybe it's 3%, maybe it's 4%. And the fact that that in and of itself could be market moving. You buy that?
It could be. I mean, look, at the end of the day, they were comfortable running way below the 2% bogey for years and years and just made us believe that there wouldn't be deflation. So if they say, hey, look, guys, we're going to run way above 2% for a long time, but we're going to get rid of the really crazy, edgy, inflationary stuff on our path there, I probably would communicate that. I think it makes sense. There's no way they can get it to 2% in 1 year. That would be a giant recession to make that happen. So I think that would be silly to try to do that. I think they should do that, and I'd probably be more optimistic if they did, but I don't think they will.
But you just underscored the point about maybe why it's difficult to get too negative, right, ahead of Powell on Friday. What happens if he, in fact, is flexible in a way that people don't expect him to be?
Look, the curve's inverted. Okay, it's massively inverted. The 2 years above the 5, it's above the 10. It's been there for a month or two. The market knows that the probability of recession is much higher next year and that the Fed's likely to continue to raise the front end until they can slow down inflation. So I don't expect that we'll get a huge rally. I don't expect them to get super dovish at the meeting. But I think more importantly, I don't believe stocks can act incredibly well all the way through the fall when the earnings go from 243 to 210 or 215 for next year. I think that's asking a lot. Do I think there's pockets of things that work? Yes. And I think what's interesting, they were just talking about it last hour, everyone wants to go back to the playbook, and you saw it in July. Let's get hyper growth. Let's get crypto. Let's get software. Let's get I don't think the new leadership in the new cycle will be exactly the same. It never has been in the previous half century. It's always something new.
What's it going to be then?
For me, there's 3 areas that are going to work. One is healthcare, all right? And I think it's across the board. that services are going to grow above GDP. They have lower volatility. They have pricing power. Probably pharma, which is just incredibly cheap versus other defensives. Biotech's worked here. It makes a little bit more sense to me than some of the other areas. So, and I think the other areas are going to be energy and materials. We've talked about it. I think a real cross current in the market that's a little odd, a disconnect to me is, so you're taking down oil and copper because there's a demand recession, but at the same time, you're going to let all the risky stuff rip higher?